So the reason we're on the sidelines is really because we're anticipating that a number of deals that we weren't awarded last year to come back around. Really for a couple of reasons, right? If you bought the deal in the last 3 years, I'm assuming that you've got debt coming due, and interest rates are quite a bit different today than they were, even just 6 months ago. And if you hadn't forecasted correctly on where interest rates were going, something's going to happen within your cash flows, right? There's going to be overruns just to cover debt service. Part two is if the business plan was based on, we're talking crazy rent growth assumptions of like 12 to 18% year over year, which simply isn't sustainable. And so kind of the same comment on debt. We're anticipating that if you had made certain assumptions on rent growth to cover expenses and it's simply not there, you compound that with the rising interest rates, and now you're in a real pickle.
Hi, Adam Gower here, founder of Gower Crowd, and welcome to the next in our series of conversations about the reality of real estate, the Real Estate Reality Show. And today's guest is Brad Aarons, who is president of Concord Development Partners in Scottsdale, Arizona. Now, Brad is actually a member of the Gower Crowd Inner Circle, and we meet fairly regularly, actually every Thursday. And in last week's conversation, he and I discussed the market and what's going on in the market and came up with three core ideas that we're going to be talking about today. They are as follows. One, why is he and others actually sitting on the sidelines in this market? The second question is, and I've got to check my notes here, why is he passing on deals? Why passing on deals while other people are buying them? If you look at LinkedIn, you see, oh, this deal closed, that deal closed. Brad is passing on deals. So you're going to learn why he is passing on deals at the moment. It will blow your mind, right? Some of the things that are going on in the market, you're going to hear about it today. Beyond comprehension, some of the ways that deals are getting done at the moment. And the third thing, frankly, this is, as we move into this period of downturn over the next few months, this is probably the most important idea that investors, passive investors, need to get used to and need to condition themselves to understand is important. That is the need to act with indecent speed. When you see a distressed deal, when you see an opportunistic acquisition during a downturn, it is vitally important that you move with blistering speed. Now, that does not mean that you should move foolishly, right? You still need to take the same steps. You still need to do your due diligence. You still need to be thorough, but you simply do not have the time that you would normally have during a good market. Brad and I talk about exactly how to deal with that challenge of moving quickly in order to acquire heavily discounted real estate opportunities during a down market. All right, so if you want to know more about Brad, I'm going to put a page up on the gowercrowd.com website. Go there, hit the podcast button, and look in the link there. There's also, it's actually a search bar, so you can look up Brad Aarons or Concord Development Partners there, and you'll go straight to the podcast page. And I'll put a bunch of links to his website and to his LinkedIn profile, make it easy for you to find out more about Brad and how to reach out to him. And while you're there, of course, also go sign up for our newsletter. We have the only newsletter that really covers the details of the real estate syndication industry, the real estate crowdfunding industry here in America. Yes, so we send out a newsletter every Wednesday. So go ahead, sign up on the website. And also we'll post this conversation with Brad and all of them in this series 5 of the podcast on YouTube. So go ahead and make a comment, post a comment there on YouTube if you would. It'd be good to hear your views, and I will definitely respond to your comments there on YouTube. Let's get a dialogue going over there. All right, that's it for my introduction to today's podcast or today's conversation. Now let's turn it over to Brad Aarons, President of Concord Development Partners. Here he is. Brad, thanks for joining me today. I'm delighted to see you. You and I discussed last week on the Inner Circle call 3 key questions to address. So let's go through those 3 key questions today as we look at this dislocated commercial real estate market. Number 1 question, Brad, why are you sitting on the sidelines right now?
Yeah, great question. And Adam, thank you for having us on today's podcast. Very much appreciated. Yeah, I mean, it's a question that we're discussing constantly as a team is why are we sitting on the sidelines? Because we still see deals, right? We still see opportunities. But I think what's really kind of driving our decision to, patiently wait for the right opportunities is we went back and reflected on last year. And I'd actually say the last 2 years, and looked at all the deals that we had analyzed. And I would say, I think our stats were last year, we looked at something like 330 different deals. And on the ones that we didn't get, we had made best and final almost on 90% of all opportunities that were publicly marketed through national brokerages and so forth. And ultimately, we didn't win the opportunity because we simply weren't comfortable with some of the assumptions we would have had to push the envelope to secure those deals. And, some of that criteria would include, excessive rent growth year over year, continuing to look at cap rates as an exit, with no basically volatility, kind of remaining flat during our business plan hold period, as well as debt. And as you guys probably know, on most value add, type projects, we were looking at bridge debt with a three-year term with a couple of 1-year extensions. And where we really started to pump the brakes is back, if you guys remember back in February of 22, when the yield curve inverted, that kind of raised a few of our hairs going back to 2007 in the last recession. And so really, we just started kind of automatically adjusting more conservative assumptions when a lot of our competitors were kind of keeping the pedal down, so to say, and we're continuing to push forward. So the reason we're on the sidelines is really because we're anticipating that a number of deals that we weren't awarded last year to come back around. Really for a couple of reasons, right? If you bought the deal in the last 3 years, I'm assuming that you've got debt coming due, and interest rates are quite a bit different today than they were, even just 6 months ago. And if you hadn't forecasted correctly on where interest rates were going, something's going to happen within your cash flows, right? There's going to be overruns just to cover debt service. Part 2 is if the business plan was based on, we're talking crazy rent growth assumptions of 12 to 18% year over year, which simply isn't sustainable. And so kind of the same comment on debt. We're anticipating that if you had made certain assumptions on rent growth to cover expenses and it's simply not there, you compound that with the rising interest rates, and now you're in a real pickle. And so we're just kind of, luckily we exited out of quite a few projects last year, or we finished up projects last year, first of this, and we just have, patient capital waiting for the right opportunity. And so we foresee between now and the end of the year that, we would like to position ourselves that if there's a struggling opportunity that we can come in and get creative and help you figure it out.
Right. So I've taken a bunch of notes. I do try not to tap on my keyboard too much. I've heard it very loud in the background on prior recordings, so I'm tapping slowly. I might need to get another keyboard. But I have taken some notes, and I've got a few questions. The first one you said was that the underwriting assumptions that you were using as you were putting in these offers last year. It's interesting that you said this. You said it this way. You were uncomfortable tweaking the assumptions to such an extent that you would have had to do it in order to win the bid. In other words, to justify a higher price. The
Correct.
implication of that is that somebody else did. And my
Correct.
first question was, what kind of rent growth assumptions? You cannot be seriously telling me that some of your competitors out there buying these deals that you were trying to buy were assuming 12 to 18% annual rent growth figures last year. Seriously?
Correct. Yeah, I'll give you an example. Not I won't give specific addresses, but we made best and finals on a, let's call it, a larger 200 plus multifamily unit project in Florida. And let's just say that the offer price, or kind of whisper price, let's call it 40 million bucks.
Mm-hmm.
And so as we made our first offer and ultimately made best and final, we had actually pushed it up to 48 million. And by that, that was actually using today's in-place rent growth. At that time, it was like 8 to 12%. But then we really dovetailed that off in like year one of operations. We were almost like flat while we're growing expenses. And we were already artificially inflating our interest rate by about 150 to 200 basis points. And 48 million was like, that was it. That's our best. And that deal, after it went to best and finals, it was eliminated down to top 5 buyers. We were one of 5. And ultimately, that same deal was secured by an international buyer who ultimately paid 65 million for that deal. And we went back through and looked at, okay, using our current assumptions, if we plugged in a $65 million purchase price, for us, it was like a 1% return, almost even like a negative return over a 3 to 5 year hold. So just out of curiosity, we kind of went in and made a couple different tweaks, to rent growth and expenses and debt. And the only way that deal would have made sense is either your cost of capital is like less than 3%, or you were growing rents by 12 to 18%. You were assuming that interest rates were going to remain flat, possibly even begin to decline, and your expenses weren't increasing whatsoever. So, I mean, we would really have to turn quite a few dials that we would never be able to justify to anyone that we could get to that number.
That's an extraordinary.
Adam, I could give you between Florida, Austin, Phoenix. I could probably give you at least half a dozen other similar stories of you're just kind of scratching your head going like, oh my gosh, like.
It's one of those circumstances. I've been through these cycles a few times, and sometimes when you see these numbers, you kind of wonder. What am I missing? How is it that this guy is what I'm missing? I must be missing something here,
Right.
And then you pass and you think, well, I'm not in the game. It can be very tempting.
Right.
I'm not in the game. Other people are, it seems you look at LinkedIn or wherever, making it hand over fist, making it seem like it's really easy. And I look at these numbers. I remember looking at them in the run up to the global financial crisis, or the great financial crisis, 2007-8, and just not ever being able to get anything under contract.
Right.
And just thinking, gosh, I'm obviously, I don't know. I was afraid I was too conservative.
Right. Well, what's interesting too, and that was kind of a weird anomaly, is we would have a number of investors, right, kind of going like, hey, let's deploy. We're ready. And to be as a sponsor sitting on this side going like, I hear you, totally get it, but I'm not doing it, right? Because at the end of the day, when this thing goes south, you're not going to remember you pushing me to buy this deal. You're going to say, what the heck, dude?
You lost my money.
You lost my money. Yeah. We're not performing the way you projected. And I can't go, well, if you remember, Mr. Investor, a year ago, you were pushing hard to deploy. And I've been that, I've never done that, but we've had deals not perform the way that we had anticipated. That's just part of the learning curve early on. And, I would much rather preserve capital than to deploy it in a deal that I simply can't buy off on when it comes to, turning different dials to get that deal done. No way.
It's interesting. There's a book I like to quote. It's worth reading. It's from the night. It was written by a fellow called Robert Ringer. It's called Winning Through Intimidation. It's written in the 70s. I don't know if I said that already. He was a broker, an up and coming commercial broker. And he wrote this book about winning through intimidation, meaning not intimidate people, but how to overcome being intimidated by, these guys that were, big egos that just wanted to crush you. So that was the general thesis of his book. It's only a short paperback, and it's not been published for decades. You can get it on Amazon. But there was one line in there that I'll never forget, where he described with some cynicism developers. He said a developer will build an apartment building in the middle of the Sinai Desert if investors will give him the money to do it. Meaning, even if there's no demand at all in the middle of the desert, they'll build if they can raise the capital to do it. Right. It's a very cynical approach or perspective, but that's exactly what you're talking about.
Right. And I think, we see those, right? I mean, even in our market today, we still see, projects going vertical where you just kind of scratch your head and go, okay. And sometimes you wonder, what's the inner workings of what that model looks like? Is it simply a merchant builder who's raising the capital, going to build it, and then exit out of that deal? So they might look at that as, look, this is a fee generation for us. We're going to get development fees over the course of construction and then deliver a project. And, the mentality of if we build it, they will come. For us, we look at high barriers to entry markets. We do tons of demand and supply analysis to make sure that not only is there enough demand for my project, but enough demand for 2 or 3 additional projects to come online. Mm-hmm. And also what's also important about us is that we actually invest in all of our developments. So, we're in it for the long haul. So we will develop it, oversee construction, and then we ride the wave during lease up as part of our business plan. So, if we're just anticipating of building it and exiting, that's really not what we do.
That's
it for the long haul.
Exactly. Yeah. And that actually opens up such a large discussion about promotes that are structured with IRRs. And I think we've talked about this.
We have.
Yeah. I mean, if you've got an IRR hurdle for a promote, that's how everybody has been conditioned, especially this new generation of accredited investors. Mm-hmm. You've got to look at the IRR, but that is so easily manipulable. And it also creates a misalignment of interest, because if you're pushed out longer between the developer or the sponsor and the investor, because if you're pushed out further and further, that IRR just gets compressed. And the sponsor starts looking at it because the only way I'm going to make it my promote is by selling now to get that IRR up. So, and that could be in a down market.
Right. Yeah, it's interesting. I mean, I would say mainstream equity is still running on the IRR model. Mm-hmm. So, if I'm a fund and I've got to deploy cash, right? You make the decision of, do I go with the sponsor who is confident in their business plan and kind of pushing the envelope to hit my IRR hurdles? Or do I wait for a group like us who, we almost could arguably say underwrite assumptions so conservatively that, we don't win every deal, but at least the deals that we do. And if I can get you comfortable with, those returns based on our super conservative assumptions, then we still look at it as, look, 3, 4, 5 years from now, when it comes time to us to exit, I've baked in so much cushion that, I feel like I can mitigate a good chunk of risk when it comes time to exit. But then what's also interesting on the flip side, as you and I had spoke of moving from an IRR model to an equity multiple model, we're gaining much more traction on the private client. That's what we define as high net worth accredited investors versus institutional capital. We're gaining more traction on, look, you and I are aligned. Let's move forward. As soon as I have return of capital, right? Then let's start getting into a little bit of a promote structure based on an equity multiple. And look, Mr. Investor, if I can in essence double your money, over the next 5 to 10 years, give a little wiggle room, then at an IRR, it still shakes out to probably a 12 to
Well,
a
that's
7.
right. That's exactly the point, isn't it? That this new generation, there's two generations, or what this last few years has created a generation or new generation of sponsors who are new to commercial real estate and have never been through a downturn,
Right.
and a new generation of investors who are also new to commercial real estate. And so when you get these two communities or these two groups together, what we've seen, and I know you've seen it as well, is this kind of competing for the biggest IRR.
Right.
You got the biggest IRR. He with the biggest IRR wins.
Right.
Because the theory is that from an investor's perspective, hey, if he falls short, he'll fall to a 12. Right? If he's projecting 24 and it doesn't make it, he'll fall to a 12. The problem with that is that's not what happens. If he misses, he's going to fail completely and you'll lose your capital. It's not he'll fall short, he'll lose everything.
100%. 100%. Yeah. We've talked to a number of, other sponsors, let's say in non-competing markets. And yeah, half the pitch that they would make is they would shoot for best case scenario returns, especially in the last 12 months where, you could almost plant a flag in the ground in the last 12 months of 2022 and make money, right? It's when it corrects. So if you're not exiting that deal, let's say third quarter of 22, and you still think that the market's just going to continue on the way it was, that's where you get stuck. And I've talked to a number of folks. The younger generation is like, yep, I want the deal. We need the deal. I'm going to turn some dials to get the IRR up. And then, look, if the deal doesn't perform and I still deliver, let's say a 10 to a 12, right? The response is, well, it's better than you would have done, in a CD or the stock market, versus, and I think anyone who's been doing this long enough, our goal is to actually grow our investor base, have you be raving fans about investing with us. So, if I was to get Mr. Investor comfortable with a 15, which is like, let's say base case to maybe worst case scenario in this market, and over deliver and hit a 22, right? Now you're going to tell all your friends about that deal and you're going to repeat invest with us. So long haul business plan, grow the investor base, have you raving fans, not, do really well in a, hyperactive market and then see you later.
Exactly. And so now what you're seeing in the market, are you seeing, so you described this one example from last year. The term you say is these deals are coming back around. So are they coming back around from sellers who didn't sell, or are they coming back around from buyers who bought with ridiculous assumptions?
So we're seeing two things. So probably first quarter of last year, historically, we've always been ground up development. We had started to open up more on the acquisition value add front. So, and we were chasing multifamily, retail, and office, some industrial, but industrial in our region is just on fire, similar to multifamily.
Right. And you're in Arizona, aren't you?
Correct. And so we had been chasing a couple of office deals that we were either evaluating as just a value add kind of price per square foot play, or some sort of adaptive reuse or redevelopment altogether. And what we found is almost every deal office related that we offered on, second, third quarter of last year actually came back around. I'd say 75% of them didn't end up trading. They would tell us to basically pound sand based on our offer. And then 3 to 6 months later, they'd call us back up and say, hey, if you can still honor that offer, it's yours all day long. Problem is markets continue to adjust. And,
falling sword. Exactly.
And no, we could not, basically honor that price that we did 6 months ago. And then on the multifamily side, we're not seeing the opportunities come back around yet. I think because most of what was marketed last year actually did trade. But what we're waiting for is that on the multifamily side, deals will be coming back around, and we're starting to see it. And I think it's super interesting is, so we're registered as investors. We invest in others as well. And on some of the ones we haven't invested in, we've been seeing a lot of webinars, investor webinars, where you're basically kind of saying like, hey, nobody worry, everything's fine. We've done some stress testing, no problem. But just so you know, we're no longer making distributions. We're going to withhold all that cash for incidentals. And then they go quiet, and that's been like 3 months.
Really?
And you kind of sit there and go, okay, so I know your profile. You're a relatively new sponsor. You basically started your shop within the last 5 years. You had a huge run up. And I know a lot of the product that you acquired, you overpaid, right, to build that portfolio. And so I think it's interesting that we're having a webinar-based discussion of like, we're okay, but no more distributions. Sit tight. We don't anticipate a capital call, but it might be coming based on interest rates rising. So those are the things that we're paying attention to.
So that's interesting. So now we're talking about distress, right? Now, the implication of what you just said is that some of these deals are going to be falling into distress. The owner's going to run up against bank debt, and possibility of losing it to the bank, wiping out existing investors. I mean, that's what we're talking about.
Yep.
So how are you tracking those deals? Are you calling the sponsors saying, hey, look, we know you've gone quiet. We know you're in trouble. We could give you some pref equity. I don't know. What are you doing to shape this tree out? How are you anticipating it's going to happen?
Yeah, so we're kind of doing what I would define as like a soft touch. Not coming in super aggressive of, hey, are you guys in trouble? We're here to help. It's more of like, hey, just checking in, seeing how things are going. Just as an FYI, there's a couple of assets that you guys own that we would love to take over. Just keep us in mind, and that's kind of been because I still think that there's a bit of a discrepancy in the market between reality and expectation. Exactly. And so we still feel like some of these groups, who do have a decent portfolio, it may still be performing, just not at the level they had initially anticipated. I think as the market continues, interest rates do continue to climb, banks do begin to pull back, start making calls and so forth. Those are going to be some things that were never anticipated. And we're just kind of continuing to hopefully stay top of mind, during kind of this weird transition period that, you think of us. And then when I think that there also becomes, kind of a known quantifier of, something's going on, then it's more of a direct approach. Here's how we can help. Here's how you can save face, all these things that we could come in and do to relieve some pressure off of, a challenged asset.
Are you having any conversations or with banks?
So we're just starting to have those conversations now. Again, it's interesting. Probably first quarter, we had reached out to few of our lender relationships of just kind of, making sure they realize here's what we do, here's what we like to acquire, here's how we can perform. And at that point, it was still like, nope, we're in good shape, no issues. But I think there's some inner rumblings of, there are some issues. There will be some challenges on, certain performance of debt and assets associated with that debt. So again, we're just kind of continuing to stay in touch, pump out a bunch of material on, here's how we can help, white papers on transitioning on distressed debt, distressed assets.
Really?
Yep.
That's interesting. So, but you are hearing some movement with bank special asset teams.
Yep. Yeah. I mean, I at least know of, a couple of colleagues in other markets where, the lender came back and basically called the note based on potential for non-performance.
Really?
Yep. Yeah, it wasn't in Arizona. It was in an adjacent market. But we're also, on our own portfolio, we've got 2 projects that are still in lease up. Bank approached us on hey, we might need to reevaluate. Luckily, on the guarantor side, we had a very strong guarantor. We're able to navigate through those waters with no issue. So yeah, so I think it's coming.
Yeah, and there's no doubt there's a lot of if you look carefully, you see conversations about the issue of marking assets to market
Hmm.
for banks. At the moment, if an asset, if a commercial loan is continues to pay current, right? Even if it is clearly worth considerably less, or even considerably less
Yep.
than originally appraised when the bank made the original loan. The bank is not marking the loan as impaired or non-performing or substandard or whatever. It's just cruising along.
Right.
So if a $20 million loan, just to make a deal, let's say a property with a $15 million loan on it, continues to pay current, even if the value of the property has dropped to 15, the banks currently are okay with that.
Right.
Cognizant, but okay with it. If the Fed decides to do what they did during the global financial crisis and mandate banks mark everything to market, that's going to have a profound impact
Correct.
on what happens. But the question is, will they do that? Because we
Correct.
all know that's just going to turn. I mean, it's bad in banking's bad enough as it is, with deposits flying out of banks.
Correct.
Right? Yeah. So let's talk about this one last topic, and then I've got one. I like to say I've got one last question before my final question.
Okay.
So we also talked about this idea that investors need to understand that a distress market, which is the one that we're heading into over the next few months at the very least, need to understand that it's very, very different from the good times market. A good times market, you've got, 45 to, I don't know, however long, 45, 60 days to do your due diligence, then some time to close. And you've got all these luxuries,
Yep.
right, as you move into a market during a good market. But during a bad market, you got to move with blistering speed sometimes. And
Right.
you've also got to move with hard money sometimes and limited due diligence capabilities. Just talk about how the buying process, acquisition process during a distress market is different from the way it is during the usual kind of good times market.
Sure. Sure. I think it really just comes down to sponsor performance, track record, and investor relationships. So for us, as we're kind of gearing up there's a number of assets that we've earmarked, all right, that we're anticipating some sort of movement in one way or another. And what we're doing is we're actually starting to run the traps. So right, as we're kind of like in this weird lull, we're not chasing a ton of stuff, but we're gearing up, for that correction. We're actually starting to, enhance our almost pre-due diligence on these assets we've earmarked. So, for us, it's crazy to think, but when we enter escrow, we actually have a due diligence tracker of like 220 tasks that we go through before we'll actually go non-refundable on that deal. And I'd say about 75 of those tasks we can knock out before actually controlling the asset, just based on what we have access to through, our broker network, co-stars, lender relationships, public records, title, survey, all that fun stuff. We can actually get about 50% through due diligence on a particular project we've earmarked before we're even in escrow. So if it's a project that comes around, right, we're already about 50% ahead of the curve of what we would anticipate most of our competitors being. Because even if it's a smoking deal, right, for us, we still have our fiduciary to our investors to make sure we've ran all the traps on the due diligence front before we're going to commit any sort of dollars to go non-refundable or actually execute on that deal. So it's kind of crossing our T's and dotting our I's to make sure that when these deals come along, we're a good chunk of time ahead and just being prepared to move quickly. And then I think on part two, so that's on the acquisition front. On the investor front, it's starting to, educate and transition from, look, the market has changed. There will be opportunities there, but let's talk about the A, B's, and C's of how we can execute on a great deal in a short period of time versus, the last 12 months, 24 months, 36 months. So it's this education process of getting investors comfortable that, look, you should know by the time we bring you a deal, we've already done this amount of DD. We have this amount of time remaining to finish out that process. So when we do go non-refundable and ask for your capital, you're still getting the same process you're accustomed to with us. It's just we've already done a big chunk of legwork up front.
Okay, so that's interesting. What I was getting at was during a distress market, and that's obviously that's how you establish a relationship, with your investors. You want them to understand that you're still doing your homework. But the point is that when you see a distress deal, particularly if it's from a bank or some other source, you have to move super fast.
Super fast.
All right. So what does that mean? So that means, let's just kind of, peel that back. That means you're going to call your investors and say, hey, we've got a deal. We have to close on Friday. All right. So just how does that happen? And how do you then make up that 50% during that week? And why does it happen so quickly?
So I think for us, and we may not be the group that can move in like 5 days, but we could move in like 15 days. And so again, it's part of, there's still making sure we're utilizing every piece of time that's at our disposal. Because you got to think, even if I was, a bank gave us an opportunity, we still have to get control of it, right? There's still a negotiation process. So instead of, hitting pause, getting through the legal component and then moving forward, we can also utilize that time of negotiating out that agreement to finish out our DD, start educating our clients of, look, we've been awarded this deal. We're going through the traps on the legal side. We're finishing out DD. We're going to be basically asking for your funds in the next 5 days to then close in 15. You guys have all been waiting for this type of stuff. We've been talking, we've been educating. Now is the time to execute. And guys, I'll tell you right now, by making this first investment with this first bank, there will be floodgates that will open up for us for these types of deals moving forward.
Yeah, it's a crazy world when it happens. I have to tell you, when I was selling notes for a bank during the last downturn, during 2008-9 period, we did not sign contracts when you had to make an offer and sign contracts. We gave everything that we had. Here's the whole file on it.
Okay.
We need to close this on Friday, and whoever is here first with a wire and signing the purchase agreement, they get it. Right. It's kind of mad panic, but that's what happens during it. That is what distress is. Let me ask you just actually one final question. Have you guys bought notes? Do you buy notes?
The last
notes being non-performing loans from banks.
Yeah, the last note I bought was in 2008.
Oh, you did?
2009, yep.
So you'd still look at buying notes?
Yep. So that was earlier on. So we were kind of still in, I'd say, like an infancy stage, right? We'd only been opened up for about 5 years under a different brand than the one you see here. So what we actually did was we would acquire a couple different notes, package them together, and we had an investor who loved notes. So we packaged them together and basically sell him a portfolio of notes. So our hold period on those was relatively short. But, looking back on how so much wealth was created in 2009, 10, 11, and 12, both from distressed notes and distressed assets, that's really what we're gearing up for, is to take a run at this next cycle and ride the wave, through correction. That's really our primary business plan for 23 and 24.
Right. That's why we're talking.
That's why we're talking.
All right. Now, truly, my last question, Brad. So what resources do you use to keep your finger on the pulse of what's going on in the market? Like what news medias and whatever? Yeah.
Great question. So obviously we're tapped into everything that's kind of public mainstream, which we found by the time it hits the public mainstream, it's already happened. And so, what we do is we just continue to keep lines of communication open with brokers and what we would define as decision influencers, right? CPAs, financial advisors, lenders. We do a lot of, communication direct to seller to get an idea. We're constantly tracking both, comps, projects on the market, starting to look for trends in the data that we accumulate. We also have a way where we're tracking loan originations, loans coming due, as well as some loans that have been, let's say, like red flagged, or they're being monitored closely. So we track those in conjunction with all the other data. And then part two, we have a bunch of internal programs where we can just start to see like different trends unrelated to real estate, but labor markets, economic cycles, different things. And, you put all those together, you can start to see a trend line of where we're predicting things are going. Also looking at, the 20-year forward yield curve for SOFR and the 10-year of, where's that kind of projecting. So you take all this data, a bunch of smart folks, analyze the data, put together some fancy graphs to give us an idea of where we think things are going. And then as we look at deals, we take all that data and we start to forward project on where we think things are going. And we do it always in a justifiable way where if an investor asks the question, you'll never hear from us, oh, I think, I hope. It is based on analytical data of where we think things are going based on A, B, and C. And here's why we're underwriting to that degree.
Outstanding. Brad Aarons, President, Concord Development Partners. Thanks so much for joining me today.
Adam, thank you so much for having us.
Right, that was Brad Aarons, President of Concord Development Partners. Fascinating discussion. If there is only one thing that you take away from this conversation, especially if you are a passive investor looking for opportunities during this down cycle, this commercial real estate down cycle, it is going to have to move much faster in making decisions than you are used to. But that does not mean that whoever you are investing with, whatever sponsor you're investing with, gets a pass on doing thorough due diligence. Due diligence is still important. You've still got to do it. You've still got to be thorough and detailed. But you do have to move very, very quickly. So get ready for that during this downturn. And my last words, I guess, today, Brad, thank you so much for joining me. Oh, my goodness. It's good to see you. I'm glad that we had the opportunity to record this. Thank you, dear listeners, also. And if you're watching this on YouTube, thank you so much for watching. Go ahead and let me know, let both Brad and me know what your thoughts are about this topic in the comments below. And we will both engage with you. I'm speaking on Brad's part as well, of course. I certainly will engage with you in a dialogue. Would love to hear your views. Again, thanks so much for joining me. Brad, thanks so much for joining me for this week's or today's conversation. Thank you. This is Adam Gower signing off.